Okay. Yeah, so thank you again to EWOC for giving us this opportunity to be able to sort of create this mini webinar series of getting into the nitty-gritty of applying for a loan. I mean, I think it's one of the biggest questions. We get the most frequently asked questions that we're going to get to address today. So thank you to those of you joining. I see somebody who was here last week. So thanks for joining in. And we're just going to get right into it again. So I'll go on to the next slide. So underwriting, let's see. Who's controlling the deck? Is it?
I'm trying to.
Okay.
Let's see. Okay, that'll work.
Okay, so just quickly a little bit about Feed the Hunger Fund, and sorry for those who have already heard this, but we are a small nonprofit organization. We are considered, we are called a CDFI, which stands for Community Development Financial Institution. So we focus on giving grants, micro grants, and we have two teams, one in Hawaii, which is comprised of myself, Aaron, and another one of us, Eric. He's in the bottom right-hand corner. He's actually lives on the Big Island. And unfortunately, he couldn't be here with us today, although he will be joining us next week. So it's a really small team. And then we have a team of California loan officers, which is Juan and Meche. And then our CEO right in the middle is Patty Chang, and she grew up in Hawaii. She grew up in Manoa. And she currently lives in California, which is why we have teams in California and Hawaii, because it's two places that's very close to her heart. And the other faces that you see on this page are our board members. So we have board members both in Hawaii and in California. So we are a really small team in terms of staff. And with our board, this is our whole team right here. So our mission, as you could see on the next page, is to work hand in hand with the funders and borrowers to build a world where access to opportunity and capital create a greater food equity, security, and sustainability. So we basically are trying to build food equity, sustainability, and also just opportunities in general, not related outside of food as well, to create this opportunity through giving microloans. So microloans is anything for us, what it means is anything from about 5,000, which is a small loan, all the way up to 250,000, which is a bigger loan, but our average size loan is about 40 to 50,000. And the difference between us and a traditional bank is that we do work hand in hand with our borrowers. And we do everything we possibly can to help you and your business succeed. We give very personalized technical assistance is what we call it. So it's just basically any kind of assistance you may need regarding your business. And we also lend to those who don't qualify for a traditional commercial bank loan. So that's who we are in a nutshell. So thanks for letting me go over that again. And today, we are going to get into underwriting, which is really, Aaron will explain it, but underwriting. So last week we kind of went over what is good debt, what is bad debt. And so here we are. This is the point at which, okay, so you learn what good debt, bad debt is. Now we're going to start applying for the loan. And we're going to sort of go over, Aaron's going to go over what the process is for once you turn in your application and all the documents and whatnot, the process that he goes through. And Aaron himself, it'll either be Aaron or Eric, who are our loan officers. They will actually be the people underwriting your loan. So this is an exciting webinar for me, because this is the thing that we do day in, day out, and people ask so many questions. So Aaron is going to take it away. And if you have any questions, please feel free to just unmute yourself, ask, put it in the chat, and we will be able to address those. Okay, ready, Aaron?
Thank you. So underwriting is the process through which financial risk is estimated, and the loan underwriter collects their financial information and determines sort of the likelihood of repayment or the risk to the lender based on this information. So that's the definition, just so you know, have a baseline. What goes into that, everybody may or may not be familiar with sort of the C's of credit. I think every year they add a C or change a C. 5 C's, 4 C's, whatever. So these are the C's of credit that are, I think, most pertinent to feed the hunger, as well as, most traditional lenders or lenders in general. So it's sort of the ones that we'll be looking at is your capacity. So what is your ability to repay the loan? And the information that would be collected to help inform this are things like the tax documents, year-to-date financial statements, including a balance sheet, your bank statements, sort of to help verify things, a household budget, and a credit report. The next sort of C there is the collateral or capital, and those are assets that can be used to secure the loan or indicate your ability to repay it, such as cash on hand. The main item there to collect would be sort of a list of pledged collateral with VIN numbers or serial numbers associated with those items, as well as photos. And the third one, which is I think critically important, not so much the credit history. Yes, we'll collect a credit report with the credit score, which does provide some information. Primarily for me, from my perspective, the score is indicative perhaps of a larger conversation if it's low. But the credit report is actually a great place to pull some of the debt that would go back into the capacity up in the top there, sort of to fill out a personal balance sheet. So it is pretty fundamental to the underwriting process from that perspective. The third thing, or sort of the last thing there on that list of the character is who are you? It doesn't really get onto our quantitative analysis, but we really do want to know who you are. Why are you doing what you're doing? That's important to us as lenders. So how is this information used? Well, we take it all and we shove it into this matrix here. There's 10 variables and we get a number, and then that number is turned into a word, and that word is, excellent, good, acceptable, poor, or unacceptable. A loan is approved primarily acceptable and above. So you're really trying to strive for, I guess, mediocrity or better on this list. I'll go through these variables or these metrics there. But there's personal net worth, how much assets do you own, less liabilities. The GDSC, that's the global debt service coverage ratio. I'm going to talk a fair bit about that. I think that's actually the most important one. All of these metrics you see here on this table are weighted equally. So you can see that if you have a low score in one, a high score in another category can offset that. So don't, like I said, if you've got a bad credit score, in this instance, this was a loan that was approved, and this borrower had a under 600 credit score, which is pretty low. But that was offset by some other factors, and they were able to end up with a risk rating of 3 there on average. But the global debt service coverage ratio is the gatekeeper to all of that. You really need to be at a high 4 or a 3 in this chart before we can really move forward with the loan process. And so I'll talk about that at length coming up. Some of these other ones, the collateral coverage is, what amount of assets are you willing to pledge related to the value of the loan? There's a couple financial ratios there, your quick ratio, how much cash do you have on hand to pay your existing debts that are due within usually we'll look over a 12-month period. Some of the qualitative things there, years in industry management. I'll touch briefly on owner's equity in a transaction. That is really how much money are you putting in out of your own pocket into this project, sort of indicating how much commitment you have. Business profitability, it's an important one. Are you obviously, if you're a startup or a new business, you're going to score low on that because you don't have 3 years of operating history. But again, low scores in one area can be offset by high scores in another, or average scores all around. And the last ratio there is your business debt ratio, which is taking the total amount of debt or liabilities and dividing it by assets. So you would want a smaller number there is better, meaning you've got more assets than liabilities. So the first C is capacity. And this is really the most important thing for us as a lender. Is your ability to pay currently is the number one indicator of your future ability to pay. So we're really looking at what is your current capacity to service the debt today. And that's the number one thing that we look at. And so that's sort of this free cash, which is the amount of money. It's basically net income. We might subtract a few things or add back in a few things and dividing it by the loan payment. So what you want here is a big number. You want to have more free cash and less of a loan payment. And so let me just go through this chart here. This is just an example I put together just so that we can talk about how a debt service coverage ratio is calculated. And up at the top there, we can see a typical income statement sort of summary there. You've got revenue. There's a monthly revenue, annual revenue. We're taking out the cost of goods sold, or the COGS, to get to a gross profit. And then we're subtracting out the expenses till we get to a net income. And so we see that this business makes $3,000 a year in net income. But to get to our free cash, we got to add back in a couple of things. The first thing I'm going to add back in is the interest expense that you might be paying on existing debt, because we're gonna take that out later, and so I don't want to be double counting it. So this person is paying $300 a year in interest expense, so I'm going to add that back into their net income. And the income statement typically will have depreciation taken out, which is a non-cash expense. So your income statement will include that, but your cash position is a little different than that, because you didn't really spend any money on depreciation. That's really just a tax thing. So we're going to add back depreciation. So we're adding back $600 to the net income. Now we're at this $3,600 in annual free cash. So this is the top part of that the equation, right? The debt service coverage ratio, where we're going to take free cash and divide it by the monthly loan payment. So below that now, I've got loan A and loan B. Loan A is $50,000 and loan B is $13,000. The monthly payments for those are obviously different given the size of the loan. The larger loan will cost you $921 a month. And the smaller loan, loan B, will cost you $239 a month. Just so that we're comparing apples to apples, I multiply those numbers by 12. And so now I've got my annual loan payments of $11,000 and $2,800. And that's now my denominator, where I take the free cash of $3,600 and divide it by my debt payments. This would assume that these are the only debt payments that are occurring in this model. If you have other debt payments, you would need to add those in as well. But assuming that this is the only debt payment, you can see a loan A, the debt service coverage ratio is 33% or 0.33, whereas the loan B is a 1.25 or 125%. And what that means is that in any given month or in a year, if the borrower that takes loan A out can only pay 1/3 of that debt back in that year, they do not have enough cash to pay that debt. Loan B, which is a much smaller loan, they have 125% of their cash to pay that loan back. So what that means is obviously loan B is far less risky. The underwriter knows that this borrower has the ability to service this debt today with a little cushion of 25% left over. And the underwriter wants to see a number greater than 100%, because if it's just 100% or a debt service coverage ratio of 1, if any extra unforeseen expenses happen, you now don't have enough money. And that always happens. So the minimum is having that sort of 20 to 25% extra free cash, whether it's a month or over a year. Usually look over a year, because your months tend to vary, right, with seasonality or whatever things might happen. So the 12-month period is typically what we look at. This is the first gate and sort of the first thing that I would do as an underwriter to determine the amount that you're asking for lines up with the amount that you're able to pay. So there's ways to change that debt service coverage ratio. The one shown here is just reducing the loan size, right? Which works if you only needed $13,000, but if your piece of equipment is $50,000, it doesn't help you at all, right? So in that instance, what do? What if your business is a startup or it lost money, or in this case, you don't quite have enough free cash flow to cover that? We can start adding in additional income from outside of the business, whether it's household income, maybe you've got another job somewhere, maybe you've got a partner, we can include their income, or you can bring on a guarantor and we would include their income. But what we would then need is all of their information as well, their tax dockets, those sorts of the bank statements, the credit report. And if we're including a household income, we also need to include the household expenses so that we can get to that free cash number and use that. So that's where we would ask for like a household budget, a monthly household budget. It doesn't have to be exact, round numbers are fine, but that would then allow us to add the household revenue back into this table that we have here, right? So we could add additional revenue. This up top here is this showing business revenue, but maybe we can add in, you've got a rental income or something, we can add revenue from that, or whatever it might be. Those are just some examples. So and then, well, I might want to pause there before I move on to talking about some other capacity issues. I know that's a lot. If are there questions right now, or I can keep moving forward?
I guess I have a question. If I'm working with SBA and they're willing to guarantee the loan, is that the same thing as, adding these extra things to try to make the score better?
Yeah, so the loan guarantee is a great tool, and it certainly de-risks it. It doesn't really help with your debt service coverage ratio. What it does help with is the collateral coverage ratio. Now, a sort of a creative thing somebody can do with a loan guarantee is, let's say that you've got a $100,000 loan and SBA is guaranteeing $80,000 of it. Something like, I think it's like an 80% guarantee, maybe make my math harder than 50%, but anyway, 80% loan guarantee. One potential way is to set up the loan amortization schedule so that you're only paying the unguaranteed portion, say $20,000 over the life of the term, say it's a 5-year term. And since that loan guarantee is for $80,000, it's safe to assume that at the end of that term, there's somebody saying, you know what, well, if they can't pay any more, here's that guarantee that will cover that unpaid balance of 80,000, right? So that's something I'm actually looking at potentially for another applicant right now. We'll see how the loan committee approves it, but I think it's a pretty good way to do it. And what that then allows now is basically your debt service coverage ratio is only looking at that 20,000, right? A monthly payment on that as opposed to the full 100,000. So I don't know if that's tracking, right? So you're gonna have a smaller monthly payment.
Okay, I can see how that's huge, and if they guarantee it.
Yeah. Oh, guarantees are massive. Yeah. Thank you for that question. Any more? All right, is there any in the chat? No. Okay, great. Must be doing a good job. So some of the other capacity metrics, but again, let me just stress that debt service coverage ratio is something that is like fundamental, absolutely critical to understanding that your loan size and the monthly payment that you can afford. But some of these other ratios now that get looked at, I mentioned earlier, sort of the quick ratio. This is your ability to make all of your debt payments from existing cash. So you'll see on your balance sheet, you've got, cash or current assets, right? And those are cash and cash equivalents. We subtract inventory from this ratio just because you have to convert the inventory into cash. So if you've got things like cash in a bank, accounts receivable, Those are things that we would include in here. And then we would divide that over the payments. So again, we would typically look at an annual time period. And do you have cash on hand to pay all of the debt off? A lot of people don't, but it's just a metric that helps indicate stuff. So again, not as critical as the debt service coverage ratio, but an overall indicator of, financial health.
Okay,
Business.
I have
Yeah.
one more question.
Yeah.
So I think you're talking about like taking an inventory of what we have and then getting a value on what we have. Is that what you're talking about?
No, more simply, it was really just the cash on hand. So the two main categories that would go into the numerator of that quick ratio is this: what's in your bank account and what's coming to your bank account that you've invoiced for. Your current, I mentioned inventories, and maybe it's a bit confusing because on your balance sheet, your inventories is included. However, to convert your inventory into cash takes an extra step. And so the quick ratio excludes that. It's a much more conservative look. So I don't know if that answers your question.
No, because my next question was, how do you even get the value of what you have? Like if
of your inventory?
Yeah, how would
Yeah, an easy way to do it is, depending on your accounting setup, if you've got like your cost of goods is a function in your QuickBooks or something, like where you categorized everything. That's any purchases you've made for a quick, like packaging, ingredients. I don't know what your product might be. In the case of a service, it's probably pretty limited. You're not going to have a lot of inventory, I don't think. Printer paper.
Well, like furniture.
Yeah, well, those are more assets than inventory. So an inventory would be what your product is composed of.
Oh, well, I think that's what I was talking in terms of assets, because I did speak with someone from SBA, and she did mention, like, get inventory so that you can kind of get an idea of what they're all valued at. But I said, okay, but how would I get that value? I didn't even know how I would go about that.
Yeah, it's a good question. Some things are easy, like if it's a car, you can just go on the Kelly Blue Book and get up the car. I will talk a little bit about collateral later, but it's really, from my perspective, make a list and put a number down that's your best guess. Because when it's random stuff, like, I mean, we've taken cutlery, it's for a restaurant, they got a lot of cutlery. I'm not going to go through and create a value for everything. They're going to give me a value, and I'm going to cut it in half or 75% of it, right? So that's sort of what happens.
Okay.
Yeah, some things like a car or a house, you're still going to discount the value because there's a cost to turn that asset into cash for the most part. But some things, like say it's inventory, if you're a rancher and you've got livestock, or you produce like a kimchi or something, we can include that as an asset for collateral, but you're selling it, right? And so there's no way we would have to be coming in every month and taking audits on your stock. So we will use it as a collateral, but it's going to be heavily discounted. You're not going to get the full face value of it.
Okay, thank you.
Yeah, some preempt the slide later, but yeah, thank you for the questions. I do appreciate it. So quick ratio is one. Business debt ratio and personal net worth are kind of the same thing, but a slightly different mathematical perspective. The business debt ratio is how much money do you owe everybody, and how much assets stuff do you have. If you owe more than you own, that's not as good as owning less than you own. Personal net worth, again, same thing. Instead of being a ratio, it's just the total assets minus the total liabilities. Kind of indicates the same thing. These are 3 additional components on our risk rating matrix that we use. They're informative for business and personal financial health, but again, not as critical as getting that service coverage ratio. Here's collateral. So here's a sweet 1983 Subaru with 180,000 miles, single owner that, can be pledged as collateral. So we would go on Kelly Blue Book, try to find out what they're saying that that car is worth and use that. The ratio is the value of collateral divided by the value of the loan. And so the target, obviously the borrower, the lender wants more. If you've got like a collateral of $100 and your loan's $100, awesome. If you've got collateral of 120, the lender discounts it to $100, and your loan is $100, even better. Not everybody can do that. Not everybody has assets. So our sort of mediocre midpoint is having a 75% value of collateral to the value of the loan. Obviously, it just provides the lender some assurances that if things go terrible, heaven forbid, there's some way to recoup those funds. I've got a note at the bottom there about owner's equity. It's not collateral. I don't have a separate slide for it. It's kind of stuck it on here. Let's say there's $1,000 piece of equipment you're purchasing. You're able to put in $250 toward that purchase, and the loan is for $750. You have contributed a 25% owner's equity portion to that loan, showing you're committed to making this happen, and that's always viewed favorably. It's like when you buy a house, or if you buy a house, that down payment, right? That 20% down. It's sort of the same thing. It's that same mentality that indicates that you're willing to put up your own money and risk it as well. So those are sort of the collateral / assurances to a lender. I don't know if you have more questions. We kind of touched a little bit on collateral there. I would say don't be scared to include your cutlery. Whatever it might be. Oh, and I will add, we're in the business of making loans and helping businesses. We are not in the business of running a pawn shop. So we absolutely do not ever want to take possession of your sweet 1983 Subaru. We want to make sure that your business is working. And so that communication with us early to, like if something's happening that maybe you're going to be late, just talk to us and let's figure out how we can help so that it never gets to a point where there's a default and a foreclosure and the assets are taken. That's a lose-lose for everybody. So that's to sort of provide some assurances around your mental health when you're committing these assets to as collateral, right? There's often a lot of apprehension possibly around that. Let's see, what other C do I have now? Character. This big nose monkey's got a lot of character. So your online lenders, where they're not talking to anybody, you just apply online, they're really just pulling your credit and looking at that number, and that's it. Maybe they'll have some of your tax information on how much you're paying, or your income per year, and they'll do their own debt service coverage ratio with the credit analysis. We do look at it, but it is one of our metrics. It's not a gatekeeper like the debt service coverage ratio. If it's low, we want to know why is it low. Are you carrying a lot of debt? Are you maximizing your usage of the credit because you haven't been able to access debt? That's a completely valid reason why somebody's credit might be lower than it should be. Other things, have you got late missed payments or accounts in collection? Those are things that we would want to understand why. Again, things like student loans and emergency medical situations are much more understandable than, well, I really wanted that Mercedes, and then I realized I couldn't. Maybe perhaps a poor financial management choice. So that's really what we're looking at when we dig into the credit report. The other thing too, though, is to go back to that debt service coverage ratio where I needed the debt balances to calculate sort of the free cash flow. That's where I'll often double check and verify that all of the personal debt or business debt is being reported. Often we're not 100% on top of what our credit card balance might be. And so that's where I'll check for that. If you have the capacity to pay off balances and catch up to to your payments before applying for a loan, I would suggest do that because it'll give your credit score a bit of a bump. You know, for some of those folks where those credit scores are you know, really important. But make sure that you give those payments like at least one cycle to go through so you see that change on your credit score. I think that's it for the credit report. So other character metrics that are important. These are not quantitative, they're qualitative, but they're super important. Is, you know, how long have you been working in the industry that you're trying to get a loan for? How long have you been in a leadership position in that industry? That sort of speaks to your capacity. And maybe it's a new business, maybe you're just starting it, but who is your staff then? Do you have a team? And so things like your resumes, your core team resumes, those things will help, you know, address those questions and concerns, right? And maybe your experience wasn't directly in the same field, but there's some sort of overlap. Just, you know, let your lender know about that and why that you have the capacity to and experience to do what you're going to do. I've made it here. You know, I pointed out that, you know, we really do want to know who you are. We have those quantitative metrics that we put together, but every single loan committee, and inevitably somebody will ask us, usually Patty, well, what do you think of this person? Who, you know, would you give them your money? And so if our answer is yes, then it's great. Obviously, if it's no, it's probably not going to go well. But so it does really pay to get to know your loan officer or the person. You know, my job is really to advocate on your behalf in front of our loan committee as to why this person, this business needs these funds and why I know or believe that they will pay this debt back. And so, you know, just getting to know the person through the application is pretty critical, I think. Let's see. Well, lastly, so it always helps too when you've got a strong relationship when things go bad, because then it's so much easier for you to reach out and share the bad news, and for, you know, the loan officer to advocate on your behalf as to why we might need to extend a little more grace, give some more time to this business. You know, they're working on it. We trust them. So back to this risk rating matrix. I've sort of in a whirlwind. I don't know if I breathed enough, or let me stop for coffee. This is fundamentally the tool that we use to approve our loans. And that second row there, the GDSC, you really want to be hitting like a 1.2, a 1.25. And after we do that, you know, we will adjust the loan size or maybe some of the terms around the loan. Maybe you got to go get a guarantor, or maybe if it's something that we can gate over time, like you can get some of the money now and then 6-9 months later with a good payment history, the relationship is, we know each other, then we can lend more capital. So those are different approaches to trying to figure out the loan. I'll pause here with this up just so I don't know if there's any specific questions or if we want to look at, you know, the scoring. I think I've approved one loan in the excellent category. I think I've had one excellent loan. I would say pretty much everybody's acceptable to good. If you're poor or unacceptable, it just means we can't lend to you now. You know, we would work with you to figure out, okay, what are the things that we need to fix or change? Maybe make introductions to somebody to help. I don't know if it's credit counseling, you need to do some debt consolidation. Are there, you know, other business development aspects that you need to work on before coming back? So yeah, I don't know what's my next slide. Well, I think, again, we got questions we got in the chat. Anything?
Aaron, I just wondered if you could bring up again kind of an average timeline for receiving a loan.
Yeah. So it is a lot of information to collect and gather, and put forward. So I'm gonna exclude that from my discussion because that's out of my control, right? That's on you. You got to get all that stuff together. You fill out the loan application, bring it in. Once I have all of that, it'll probably take a week to go through everything. Maybe there's some additional questions or additional information we have to find that comes up. You know, maybe you've got a low score or something and we've got to go get a guarantor, or, you know, whatever it might be. Or we have to have some back and forth around the actual loan size. You know, maybe you really want 50,000, but your debt service coverage ratio is only going to cover 35,000. Is that going to work? How do we make it work? You know, what can we do? Sometimes if there's a seasonality to your business, you want to have a conversation around structuring the payments. You know, maybe we need quarterly payments or whatever. I guess short answer is I would say up to a month to get money into your account. I would say typically much less. I think this week we approved loans on last Friday and they're getting money today. So what is that? That's not long. So it does vary. Plan for a month. You don't want to be in a situation where you need the money tomorrow and you can't get it for another 2 weeks. We do try to be quick. We completely understand that, you know, business without cash is is a headache. You know, sleepless nights, gray hair, the works. So I would say that I would advise to plan for a month. I would expect 2 weeks, possibly less.
Thank you. I think that's just important for people to consider, because I know some of our clients, when they're ready to receive a loan or know that they're at that point, they kind of like, when do you need that loan? Like now.
Yeah.
But what this Access to Capital webinar series is meant to help with is just the realistic preparation needed for every business to prepare for lending and know that it's a runway. And the more that you can kind of learn in the webinars like this to prepare your documentation and to look at your own analysis of where you might be for lending, it'll help you, you know, think ahead for when you'll actually need it.
Yeah. You know, it's when you're in that time crunch, you're going to be more tempted to accept some of those high interest rate short-term loans to really satisfy that, and that can be super problematic in the longer run. So really make sure you know, you're doing a cash flow analysis. You know, build out your runway, understand what your expenses are going to be over the next 3, 6, 12, 24 months, and make sure that you have enough cash to carry your business over that time frame. Definitely. Well, I guess, let's see, is that, oh, sometimes it works, sometimes, let's see what we got. No, yeah, that was it. That was all I got.
Do we have any other questions for Aaron or Shandis before we sign off? You have their contact information. I'll make sure to put my email in chat.
Yeah,
Reach out at any point. We do have financial counselors that can help, you know, you look at that cash flow analysis. I know Aaron and Shandis are available, and they have wonderful resources as well to kind of help you prep and really evaluate, you know, what you're prepared and able to do for lending. So thanks again for part 2. We're looking forward to part 3. I wondered if you could just say a few words about what you'll cover in part 3.
Well, I'm hoping Eric will be here and he will be covering part 3. But it will really be just going through the loan application. I think here's the documents you need. It's, you know, it's going to be those things that we mentioned. What does the loan application look like? What are some of the things that need to be filled out? I probably, similar to approving like 1 or 2 loans in the excellent category, I've probably received 1 or 2 fully completed loan applications. It certainly does facilitate the speed with which I can go through the loan application. If it is, I do get things like the balance sheet, and some of those things can be challenging to complete on the loan application. But, you know, there's people here, real people here to talk to help, you know, move through that. So yeah, next week we'll be going through those specific documents. Some of the key things, like if you could only, I don't really want to say this, but your tax documents, your credit report, you know, to get to that debt service coverage ratio, that's really what is needed to kick the conversation off. You know, those are the first things to really work on, and the loan application. There are, I guess, let me back up, prior to the debt service coverage ratio, sort of the eligibility requirement, which I think we talked about last week, in that, are you in the right geography for Feed the Hunger Fund? You know, is it Central Valley, California, Bay Area, California, or the state of Hawaii? That's, if you're not there, unfortunately, our funds won't be able to serve you, but, you know, perhaps we could find somebody else. Primarily, we would like to serve the food system, but not exclusively. We also are here to meet the needs, you know, BIPOC community, women, and that's really where, you know, the focus of our capital is to go. Again, we have white men that are running great food system businesses that we have lent to as well. So not excluding them either. So I think that would be sort of the first gauge, is making sure that we're a target market. Again, low income, that's another market we really want to be serving. And so we're targeting those folks as well. But I think the geography would be the first. Yeah, no, Ken. Everything else is we would like to, but it doesn't have to be. Then yeah, going through our application process. Sorry, kind of lost the question there. Hopefully I fumbled through it.
Sarah and Candace, is there any other last questions? Otherwise, we'll sign off here. Look forward to seeing you all next Wednesday, and I will send a reminder on email and share the links to this and the previous webinar as well, so you can review the information for your own businesses, and reach out to any of us. We're here to help.
Thank you everybody that stuck it out.
Thank you.
Aloha.
Have a great week.
Bye-bye.
Aloha.